capital that are interested in alternative investments at the high net worth level, right, through registered investment advisors and so forth. So I think real estate is likely to continue to be pretty resilient, even in the face of high interest rates. But it would be nice to see them calm down a little bit.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Burk, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Matt, welcome to the show.
Thank you, Matt. Glad to be here.
Absolutely. Well, we like to start with the difficult questions here. What's your favorite ice cream?
Favorite ice cream, I would say Rocky Road.
Okay. That's the one with the marshmallows in it, right?
Yeah, it's got chocolate almonds and marshmallows. Yeah.
Gotcha. Now, because it already has almonds and marshmallows, do you feel like you have to throw toppings in it, or?
No, I usually don't throw any toppings on that one. You don't want too many marshmallows. Prefer the almonds to the marshmallows, but nice to have a little mix in there.
Agreed. Well, Matt, tell our listeners, what's the scoop? What do you do today?
Well, I'm the CEO of two companies, Fairway America, which is an investment company, and Verivest, which is a service provider. Both companies cater to real estate entrepreneurs that need to raise capital from high net worth investors, and how to structure funds, administer those funds, and provide capital to those funds. So yeah, running two companies that are very related to one another.
Gotcha. Well, you've been in the real estate game for a long time. Take us back. Where did your real estate journey begin?
I started work for a company out of college called Household Finance, which is a consumer finance company, but they did a lot of real estate, line of credit, home equity loans. So that's really where I started learning about real estate valuation, appraisals, loan to values, all that kind of stuff was through that. And then, kind of took it from there. But yeah, all the way back to my consumer finance days.
Gotcha. From my understanding of your history, you jumped from consumer into the commercial side relatively quickly. Is that right?
Yeah, I think I worked there for a while, and then I bounced around at a couple shops, but I went to work for a California-based thrift, and that company it was thrift and loan, which is kind of the old days when they had savings and loans, right? Same idea. But we made a lot of commercial real estate loans. So we would make first trust deed, kind of hard money loans to all manner of different commercial real estate types. That's kind of how I got involved in commercial initially. So my early days, Matt, were all really in the lending business. And since then we've done a lot of equity, bought a lot of property and all that. But yeah, the early days was all in the lending business. And that's how I cut my teeth in commercial real estate.
Were there a lot of hard money commercial lending back in the day?
No, not nearly as much as there is today. I think, debt funds are what you know of today, that really didn't exist. A lot of these thrift and loans, there were private money shops that did some of that stuff, but it really has grown up a lot in the last 30 years. So no, I don't remember a lot of commercial real estate, non-bank type lenders back in those days.
Gotcha. Well, I've heard a story of how you started Fairway America, and really the interest that you had to pay on the loan to get the business started. And given that we're recording this in June of 2023, I want you to talk us through your shift from doing the debt side to kind of brokering deals.
Yeah, I think the Great Recession is really what gave rise to that, and coming out of and there's a whole story around that in terms of what our business model is today. But I would say that until 2012 or so, we did vast majority of the deals we did were loans. Starting in 2012, 2013, we launched what was then our sixth fund. And we allowed in the mandate in that fund included the ability to invest in equity. So we started doing equity deals in about 2012, 13. And since then have done a lot of equity. We've done a lot more equity in the last 10 years than we have debt.
Gotcha. But didn't your first loan to start a business, wasn't it like 21% interest or something like that?
Yeah, I borrow. My initial capitalization for the company was I borrowed $10,000 from American General Finance Company at a rate of 21% interest. And, I bought a laptop and I don't even think it was a laptop. It was probably a desktop at the time. And a number of things, but that was our initial capitalization was 10 grand from American General at 21% interest.
Wow. Wow. Do you remember what year that was off the top of your head?
1992.
Gotcha. Gotcha. How did you deal with the interest rates that were that high? Because I think we're in an interesting market. We'll get into this later in the conversation where people think 7, 8, 9% cost of capital is extremely high. I think we don't have to look too far back before we realize that cost of capital used to be way higher. So how were you able to kind of operate in those time periods?
Well, yeah, if you go all the way back to the early 80s, rates were prime rate was, pushing 20. So it was crazy numbers. But, fortunately, it was only $10,000, right? So, it's in gross dollars. The payment wasn't that high on 10 grand. So I think even in those days, Matt, consumer finance, if you were borrowing money from Household Finance or American General or Beneficial back in the day, that's just what the rates were, 15, 20, 25, 30%. But the dollar amounts were small. So interest rates on real estate loans were not nearly that high, even in those days.
Gotcha. Do you remember what interest rates were back in late 80s, early 90s for commercial real estate?
Yeah, I'd say, we were doing deals at the company I worked for before I started Fairway at like prime plus 3 and 4. And I'd say the prime was when I started in 90, I guess it would have been 88 or 89. They were at prime was at 11. So they were at 13, 14%. But you could probably get bank loans at some number cheaper than that, but not by a lot, 10, 11%. So it was a lot more expensive even than the elevated rates today.
Yeah. Do you think, what did that do to the operating environment? If you could remember back to those days, was it more risk adverse? Did you have to double click on some things? Like, talk us through that.
Yeah, I at the time it seemed perfectly normal to me, right? I was a, young guy coming out of school and I didn't know any different, right? Because that's what rates were at. So it didn't seem nearly as big of a deal as it does today. And rates are only, you can get a commercial real estate, deal, an agency deal on multifamily in the fives still, which historically I would have considered that to be fantastic. Now relative to what it was, 18 months ago, it's not so great, but relative to what it's been historically, it's still pretty darn good. So I think some of it too, man, is it just depends on how much time goes by. People had become used to it by then. So I think your leverage levels were just reflected and values of real estate reflected the fact that rates were just a lot higher at that time. So I don't think it was a lot different than it is today in terms of how people operated. It's just they were accustomed to higher interest rates and greater debt service.
Yep. Yep. I guess if it pencils out, it pencils out at the end of the day.
Yep.
All right. So flash forward back to 2012, you decided to take on more equity positions. Were you doing single deals or were you doing funded deals like pools of capital at that point?
We were doing pools, and it might help to give you some context of kind of how we got there. But I had a fund. It was in 2000 that we launched in 2008. Literally, we launched that fund right when Lehman Brothers was going down in bankruptcy, and so this is September of 2008. And it was a fund that was leveraged with a credit facility from Wells Fargo Capital Finance. We had a $50 million line. And we brought in the rest of the money from private investors on a note basis. So it was a highly levered fund, but we were borrowing money from Wells at the time at like 3%, 3.5%, and we were lending it out at 12. Right. So there was a huge spread in it and the margins were extremely good. But as the market melted down, Wells ended up, it was a 3-year term. And Wells didn't want to renew that line. So when in 2011, when they failed or refused to renew the line, I had to wind that fund down. So we're in the middle of the Great Recession. I'm in a position where I have to start liquidating assets in a terrible market. And I had to go to all my investors and say, hey, we're going to have to wait to get you your money back because, I have to sign a forbearance agreement with a senior credit facility. And, that was a very difficult time. So winding that fund down was kind of the catalyst for taking a real deep look at our business model. And during that time, Matt, I had a number of, I'd say friends and people I knew in the real estate business who asked me advice and guidance around setting up a fund. They said, Matt, I know you know a lot about funds. You've run them, now you're winding one down. I'm thinking about setting up a fund for a certain real estate strategy. What do you think of this? And what kind of pref should I do? And how should the splits work? And asked me a lot of questions. And I realized at the time how difficult it was for me back in the day to start my own fund. And all I really had was the ability to go to a lawyer, and lawyers they're necessary. You have to have a securities lawyer. I mean, it's part of the deal, but it's like a spoke in a wheel. I mean, if you don't have the spoke, the tire's not going to run, but it's not the main ingredient, right? It's just one aspect of running the fund. So from a manager's perspective, we were able to start. I'm winding a fund down. I need a business model. So I started doing advisory work for other real estate people who raise money from investors who wanted to make the leap from doing it one deal at a time to doing it in a pooled investment fund. And since that time, Matt, fast forward to today, this is 11 years later, I've played, our Fairway and Verivest have played the lead role in setting up probably north of 300 or more funds in the last 10 years for people all over the country running one sort of real estate strategy or another. And that's been the core of our business model. And the idea was for us that by doing that, we were going to meet other entrepreneurs, real estate people whose strategy we liked, and then we would invest in and alongside them and leverage off of those folks to help grow our business. So that was the basic thesis. So in a lot of ways, I think I spent the first 20 years of my entrepreneurial career doing a certain thing that the Great Recession kind of turned on its ear, and it really completely transformed our business model, and we've been doing that ever since.
Just so that this is recorded and stays on the internet forever, I want to compliment you on your foresight and business strategy of, I'm going to help people trying to put together funds so that I can go be an investor in those funds, and I basically get to underwrite them. So you said you set up 300-ish or so funds in your decade or so, but you've probably underwritten thousands at this point because of that.
Yeah, more than I can count.
Yeah, that's just a very interesting business strategy. When I heard you talk about that in my research, that I never even thought about, like sell the tools for these syndicators so that you can go be investors in those syndicators as well. That's very interesting.
Yeah, so we've helped a lot of folks that have done them one deal at a time, but doing a fund is very different, right? It's an order of magnitude more complicated because you have investors, you have multiple deals, multiple assets, multiple investors coming and going at different points in time. So how you treat it, how you calculate it, how you charge fees, et cetera, is all just different than how you do it in one deal at a time. So helping people navigate that, make good decisions. And, a lot of this, man, is born out of my own experience, and I've made a lot of mistakes. So trying to help other people avoid some of the mistakes that we made and do it right from the beginning. There's a huge value proposition in doing that. And if it creates relationships for us that some of our best investments and clients have come out of people that we've helped set up a fund.
So I want to take the next part of this conversation in two forms, one from the investor side and one from the fund manager side. So if you're talking to a syndicator today, so in our business, right, we raised 42 million last year, mostly from single deal sources. I understand the pain of launching a deal, raising a deal, closing the deal, moving on to the next one, and the benefits of a pool. But what are some of the things that I, as a general partner and syndicator, need to think about before I move to the fund model?
Yeah, there's a lot of issues there, and that's really what we help people walk through. But I always start with, what is your asset model? What kind of deals are you doing? How big are they? How long, what are their characteristics? How long do they last, right, before they go full cycle? Because that drives velocity of money and determines how much you need to raise. What deal volume do you have access to that you can reliably predict you're going to be able to fund, because that helps you determine whether you want to even do it or not in the first place, right? And then once you figure those things out, then what is the structure of that fund? And it needs to match the asset model so that there's a logical flow from, it starts at the asset level and then it flows into the fund. So, but the fund needs to be structured in a way that reflects the reality of the likelihood of the way that the assets perform right at the fund level. And then from there, there's all kinds of questions around, what fees are you charging? How do the promotes work? Because generally in a pooled investment fund, the promotes are not paid until all the capital is paid back, which means you're not earning a promote on every single deal, right? You're earning it at the fund level after you've paid the capital back, which generally means you're in the second half or or the final third of the assets of the fund before you're actually in the money. So then there's a lot of financial modeling around that. It's like, do you have the capital necessary to carry, the costs associated with running that fund, and how do you build the fees in such a way that, you're aligned with the investor, you're not feeing the deal to death, the fund to death, but you have enough money to actually execute on what the investors are expecting you to be able to do. So all of those types of things, Matt, are considerations that I think if people haven't done it before, it's hard to really know how to, balance all of those things. And that's kind of what we help them go through.
What's like the number one common thing you see most in like syndicators not think about when they're going down this rabbit hole? Because you mentioned a lot of different things there. I just want to try to capture the one or two.
I'd say they don't understand the economics of how a fund works compared to a syndication. They extrapolate what they know on a syndication into a fund model, and they misinterpret the way that it works in terms of the cash flows to the fund investors and to themselves. So walking them through the realities of how the money flows is probably the single biggest, thing that we find people consistently don't really grasp in the beginning.
Gotcha. All right. Now I want to take that hat off and pretend like we're talking to an investor. So to some of our listeners out there, they may not be familiar with this idea that you can have a fund that invests in multiple different assets across the fund. What are some of the things that I should be thinking about as an investor before I look at investing in a fund?
I'd say the number one thing I always tell investors is, pick your jockey wisely. Right. It's the manager is, because at this point, the investor typically does not have any choice or insight into the individual assets. They're investing in a strategy, right, that has been articulated by a manager, but they don't get to pick and choose the assets. So they're abdicating a tremendous amount of responsibility to the manager without a lot of visibility into the choice of what goes into that fund. So therefore, track record is super important, and underwriting the manager on the front end is very important, which can be very hard to do for a high net worth investor who may only be investing $50,000 or $100,000, which, is an important number to them, but it's that money doesn't really move the needle that much for the manager. So balancing, what the manager is willing to give you with what, with getting enough information that, you're dealing with somebody that you can trust, that's competent, capable, and trustworthy is the number one thing.
Yeah. And as a guy that's probably underwritten thousands of operators and GPs out there, what are some of the things that you look for in an operator before you decide to invest your own personal capital or decide to partner with someone?
Well, track record is one, so it's an easy one to ask for. It's harder to prove that whatever information they give you is real. I can tell you that having underwritten thousands of these people, that oftentimes the track record they purport to have doesn't really match with the numbers once we go in and actually try to verify those numbers. So that's a scary proposition to many investors. So I think track record is one. We run background checks on everybody. I'd certainly ask for a background check. And a lot of managers, it's not really practical for every investor to get a background check on a manager, but you should be able to at least get one to see if the manager has one, if they've thought about it. Other types of due diligence, you can get as deep as you want to in it, Matt, but I'd say for most, practically speaking, for the average high net worth investor, if they can get background checks, references, and track record information, that's a really good start.
Yeah. Well, and on the references point, like even in my own business, I'm going to give you some of our best references, right?
Exactly.
And so me underwrite, because I'm an investor in other people's deals, just like I am in my own. But one of the things that I do is ask like, hey, Matt, when something went wrong, what did you do? And I always ask for two examples, because the first one, most people probably have an example of where, I shouldn't have done that and I had a bad experience. But if they can come up with two, then that tells you kind of a track record of how they're going to deal with bad situations.
Yeah, and I always try to triangulate references. These are not the ones they gave me, but it's, especially with the internet these days, it's not that hard to find somebody that you can talk to that those people know that they didn't turn you on to. directly. So, that we always try to do that. Yeah, we're capable of doing more. I mean, I'd characterize us as, quasi-institutional investors at this point, right? I mean, we can do a lot more than the average high net worth, but is like a lot of, a lot of them online. There's a lot of resources now for high net worth investors online that didn't used to exist, that, they have forums and communities and resources that they can go to find other people that can share experiences,
Right.
And help choose managers.
Right. And I was having this conversation with my partner earlier today. The main thing that you should look for, I think, in a sponsor is somebody that will communicate the good and communicate the bad. So we like to always communicate the bad. We always like to try to do it over the phone if we can. That way investors at least hear from us and they're not just seeing an email or seeing it on social media or something like that.
Yeah, communication is huge. When we had to wind our fund down in 2011, the communication, the way in which I heard one of my securities attorneys said it one time, but bedside manner is a lot more important for doctors than even necessarily pure medical expertise, right? It's how you treat people that matters the most. So communication is huge.
I think Malcolm Gladwell did a study actually on like doctors' propensity to get sued in bad time situations. Yeah, exactly. And like that was the one thing is like how they treated the patient before and after was the number one likelihood to get sued.
That's exactly right.
I want to double click a little bit on Verivest and talk to us, like we're syndicating and things like that. So we've put together a couple of funds on our end. We are still looking for the perfect solution. So I'm going to use this time to be a little bit selfish here. But what are some of the back office administrative tasks that somebody that's putting together funds versus a deal focused syndication business? What are some of the back office functions that you can kind of take off their shoulders so that they can go operate?
Yeah, the first one is really consulting and advising on putting the structure together in the first place. So, and then we have partnerships or relationships with a number of law firms that have signed off or that have prepared the documents originally, but we'll help people put it together properly in the first place, a pooled investment fund. Then we perform fund administration services. So it's the accounting, the waterfall accounting and pooled fund accounting for the manager. We do third-party administration, which we generally find in the institutional world, that's an absolute must, right? You have to have third-party administration. It's not even an option. In the small balance or high net worth sub-institutional world, it's kind of all over the map. Some people do it themselves. Some people hire a local accountant that they have used for other things, but aren't necessarily fund administrators. Right. So that's really the big piece. And then on the Fairway side, we look at anybody that comes through the Verivest side that we help set up a fund and we do the administration for. Our objective is to find as many of those as possible that we like and that we want to invest in. So it's really a combination of advisory, admin, capital.
Gotcha. Yeah. Which if you've spent any time doing the accounting on the back end of any of these syndications, it's not something I think most real estate operators like doing.
Real estate people are, by and large, and this is a broad statement, right? But they like real estate. They like kicking dirt. They like finding property. They like valuing it. They like, dealing with the construction, hiring a contractor, getting a leasing agent, getting it leased up, operating it, managing it, selling it. They don't like, pooled fund accounting, and the difference between accrual and cash and net asset value calculations and unit prices and redemption mechanisms and, all the other things that go along with running a fund and doing the accounting properly for it.
If you're listening to this and your mind just exploded because you had no idea what half of that meant, welcome to the club. I am too. My eyes are glossing over here.
Yeah. So try not to bore people with all that, but I think the main point is that I find that people are best suited to do what they're really good at, and the degree to which you have the ability to have other folks that are good at the other component parts of it, that's better than attempting to do it yourself.
That's right. I would agree. Matt, we were chatting a little bit beforehand. I mean, you went through the savings and loan crisis in the 80s, the dot-com boom, the great financial crisis of 2008, the Great Recession, whatever you want to call it. And then
you call me old, Matt?
No, I'm saying you've earned your gray hairs in this industry and very experienced.
I'm just kidding. I don't have no hair for no reason. Right?
Well, I am trying to butter you up to get a good insight to how do you see the market today? And obviously, the real estate market is not a thing. It's all location dependent, asset class dependent, and it's a real estate markets, not market. But
Yes.
just curious, like, how are you seeing things today? And talk us through where your head's at.
Yeah, I think you're absolutely right on your last point that there is no such thing as a market, right? There's all different types of asset classes. And then even in multifamily, for example, there's class A, urban, there's suburban, there's walk up, there's high rise, there's all kinds of different things. So I think it very much is a micro situation, not a macro, but that said, if I had to paint a broad brush, I think certain asset classes, multi-storage, industrial hold up pretty well. Office, obviously, post-COVID is a very difficult asset class. I think the biggest impact, of course, lately is interest rates, right? Are they going to stay elevated? And historically, as we talked about earlier, they're not that elevated. They're only elevated relative to what they've been at for the last 7 or 8 years, right? Which has been at historically, rock bottom numbers. So, if I had to guess, man, I would say I suspect they level off. They stabilize somewhere at or slightly lower than they are today. But, you're seeing the economy seems to be super resilient, right? It seems like we added a whole bunch of new jobs, and, inflation is very stubborn. So the Fed's got their work cut out for them here. But interest rates are the number one thing, and the capital market efficiency or functionality is super important for stability of real estate. So hopefully we can see some stability on the capital market side, and that should calm things down a little bit. Big picture, I do think there's a huge amount of money that has been assembled for investing in real estate, both at the institutional level and record levels of capital that are interested in alternative investments at the high net worth level, right, through registered investment advisors and so forth. So I think real estate is likely to continue to be pretty resilient, even in the face of high interest rates. But it would be nice to see them calm down a little bit.
Yep. Are there any asset classes or markets that you've got a keen eye on that you're kind of very interested in right now, or that you're personally invested in?
I've invested a lot, and we did a lot. We went big in storage in the mid-teens, and that's worked out really well. We've did a lot of multifamily in the last few years. I'm still bullish on multi, generally speaking. And again, it's like we're not doing class A, multi in downtown areas, right? We're doing a lot of class B and C, value add multifamily, where that you're going to have lower rents and a lot of sustained demand for that. I think B2R, some build to rent, we've done some of that. I think that holds up pretty well. I think, and a lot of it for us is, as we look at investing in managers, it's as I said earlier, we like to pick the right jockey, and if we can find good people who have a good strategy in whatever market it is they're in, we're pretty open to different property types and asset types, depending on who our partners are. So I'd say multi-storage, and still like industrial, very hard to find at any reasonable price, and some build to rent. We have stayed away from office. We did quite a bit of retail actually in 13, 14, 15 when everybody was really scared of it, and that worked out well too. But I don't really see all that much retail anymore. So I'd say we're agnostic's not the right word, Matt, but more interested in finding the right operators who have a really compelling strategy in whatever market they're in than necessarily targeting a specific geographic area or asset type.
Which in general is a good way to approach life, right? Like you're just looking for the best of the best, and you're just not trying to have a preference on one thing over the other, I would say.
Yeah, I've seen a lot of really interesting strategies over the years. That's one thing I've always found fascinating about real estate, is there's a lot of different ways to make money in real estate asset-based investing. And different people take different approaches to it. But if you have good people that understand whatever it is they're doing in the markets they're in, you can make money in a lot of different ways and spread your risk around.
Yep. Well, Matt, fantastic conversation. I want to switch us now to our last round. We're calling this the 5 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
I'd say one of my favorite all-time books is called Let's Get Real or Let's Not Play by Mahan Khalsa, which is a sales book, but it's really more around, communicating with other people. And that's probably my favorite all-time sales book.
Yeah, I heard you say that on a different podcast and I wrote it down because it's really about getting down to the brass tacks of a conversation. Like, let's not BS around. Let's get down to it, right?
Yeah, courage with consideration.
There you go. There you go. Our second one is, I believe that the person you become 10 years from now is directly correlated to the habits that you have and the things you do every day. What are some of the habits that you have every day?
Yeah, well, they've changed over the years. For a long time, I kept a journal. I would write and think every day and write down goals and so forth. I did that for many years, and I think that contributed largely a lot to the person I am today. I've gotten somewhat away from that as I've gotten older. Exercise is certainly a big piece of my life, right? It's like staying fit, riding a bike. So if I could, Matt, I'd ride a bike every single day if I wasn't, busy running these companies and so forth. But yeah, it's I agree with you, man. Habits are everything.
You're making my heart warm. I don't know if you can see my little cyclist back there. I'm a cyclist as well. So
yeah, good. Well, if you're out in Portland, let's ride.
There you go. There you go. Our third one is, what is the best piece of advice you've ever received?
You become what you think about, by Earl Nightingale. It's part of Lead the Field. But it's like your life is what your thoughts make of it, right? And then you can control your thoughts. Therefore, you can control largely the direction of your life. So, you become what you think about.
Wasn't he the guy with the cassette tapes back in the day?
He was, yes.
Yeah.
He was they call him the Dean of Personal Development with the baritone voice and then the whole nine. Yeah, he was great.
I love it. Our fourth one is, what is the thing that you're most proud of in your life?
Well, my youngest son just graduated high school last week. And so I've got two boys that are 20 and 18, and they both are pretty well-adjusted human beings. So having raised two kids that putting out into the world that are in pretty good shape, I think that's probably my biggest accomplishment.
And it sounds like you're about to get a pay raise.
Yeah. Well, I'll get a pay reduction in the short run. I got to put them through college now. So but in the not too distant future, hopefully.
We just stroked our last check for daycare. So we're living large over here. Well, Matt, our last one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
Yeah, I probably would choose Earl Nightingale because he's the guy that had the most impact on the direction of my life. Listening to those tapes in my late 20s kind of really got me on the right trajectory. So just like, I'd love to have one opportunity to sit down with them and chat. And so I'd choose Earl.
Love it. Well, Matt, fantastic conversation. Loved your experience there, talking us through your experience. And then we're going to have to check out Verivest because we've got some administrative offload that we need to offload to a third-party resource soon. So you'll probably be hearing from me soon. But if our listeners wanted to reach out to you or learn more about your companies, where's the best place we can point them?
You can find me on LinkedIn, and then you go to our company website, fairwayamerica.com or verivest.com, and you can find out a lot about us there, and it's all got my email address and everything else. So, but LinkedIn's, for me personally, LinkedIn's probably the best spot.
Perfect. We will leave those in the show notes. And then Matt, thanks for coming on the show.
Thanks for having me, Matt. I appreciate it.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.